When investors think about international diversification, emerging market ETFs are often the default option. These funds provide broad exposure across multiple developing economies through a single investment. Saudi Arabia ETFs represent a different approach. Rather than offering broad diversification across many countries, they provide targeted exposure to a single market with a distinct economic structure. This video compares Saudi Arabia ETFs with broader emerging market ETFs and explains how professional investors evaluate the differences between the two when constructing portfolios. Emerging market ETFs typically hold equities across regions such as Asia, Latin America, Eastern Europe, the Middle East, and Africa. Countries like China, India, Taiwan, Brazil, and South Korea often represent a significant portion of these funds. As a result, performance in emerging market ETFs is often driven by a small number of dominant economies and sectors. Technology manufacturing, consumer growth, and export-oriented industries tend to play an outsized role. Saudi Arabia ETFs, by contrast, focus on a single market. This creates a different risk profile. Exposure is concentrated in Saudi companies, with meaningful allocations to energy, financial services, telecommunications, and infrastructure-related businesses. Professional investors begin by examining concentration versus diversification. Broad emerging market ETFs provide geographic diversification but often mask concentration risk within certain countries or sectors. For example, many emerging market ETFs are heavily weighted toward Asian technology firms. This means investors may be more exposed to global semiconductor cycles, trade policy, and technology regulation than they realize. Saudi ETFs are geographically concentrated but economically differentiated. Their drivers are more closely tied to energy markets, domestic financial systems, and infrastructure development. Sector composition is one of the most important distinctions. Emerging market ETFs often emphasize technology, consumer, discretionary, and manufacturing sectors. Saudi ETFs tend to emphasize energy production, banking, and utilities. This difference matters because sectors respond differently to macroeconomic conditions. Technology-heavy markets may benefit from periods of low interest rates and strong global growth, while energy-linked markets may benefit from inflationary environments and commodity demand. Professional investors consider how these sector exposures interact with existing portfolio holdings. Investors already heavily exposed to global technology may seek diversification through energy-oriented markets. Others may prefer growth-oriented exposure depending on objectives. Currency exposure also differs meaningfully. Emerging market ETFs expose investors to multiple currencies, which can increase volatility. Currency movements can amplify gains but also exacerbate losses. Saudi Arabia's currency is pegged to the US dollar. This reduces currency volatility for American investors. While this limits currency-driven upside, it provides greater predictability and reduces one source of uncertainty. Professionals view currency structure as a risk management consideration rather than a return driver. Reduced volatility can improve portfolio stability even if it limits speculative upside. Dividend characteristics represent another key difference. Many emerging market ETFs emphasize growth and reinvestment rather than income. Dividend yields can be lower and less predictable. Saudi ETFs often include companies with established dividend policies, particularly in banking and energy sectors. Dividend distributions may provide income support, though they remain subject to earnings cycles and commodity prices. Risk behavior during market stress is another important factor. Broad emerging market ETFs can be highly sensitive to global risk-off environments, capital outflows, and geopolitical events affecting multiple regions simultaneously. Saudi ETFs may behave differently due to their economic structure and energy exposure. However, this does not eliminate risk, it changes its nature. Energy-linked markets can experience volatility tied to commodity cycles rather than global growth sentiment. From a portfolio construction standpoint, professional investors rarely treat Saudi ETFs as replacements for emerging market ETFs. Instead, they are viewed as complementary tools. Some investors maintain core exposure to broad emerging markets while adding targeted Saudi exposure to adjust sector balance, income characteristics, or macro sensitivity. Others may selectively reduce exposure to technology-heavy emerging markets and introduce Saudi exposure to diversify economic drivers. These decisions depend on portfolio objectives rather than market predictions. Cost considerations also matter. Broad emerging market ETFs often benefit from scale, resulting in lower expense ratios. Saudi ETFs may carry slightly higher costs due to market access and operational complexity. Professionals evaluate whether higher costs are justified by differentiated exposure, diversification benefits, and portfolio fit. Liquidity is another consideration. Large emerging market ETFs typically have deep liquidity and tight bid-ask spreads. Saudi ETFs may have lower trading volumes, though they still offer daily liquidity on U.S. exchanges. Investors factor liquidity into position sizing and rebalancing decisions. Less liquid instruments are typically sized more conservatively within portfolios. Correlation analysis plays a central role in professional decision-making. Investors examine how Saudi ETFs move relative to emerging market ETFs, developed markets, energy prices, and global equities. Assets that behave differently during various market conditions can improve overall portfolio resilience. However, correlations can change over time, so diversification benefits are evaluated continuously. Time horizon also influences allocation decisions. Emerging market ETFs are often used as long-term growth allocations. Saudi ETFs may serve a dual role, offering both income potential and exposure to energy-linked economic trends. Neither approach is inherently superior. Each serves a different purpose within a portfolio. For American investors, the key takeaway is that Saudi Arabia ETFs and emerging market ETFs address different objectives. Broad emerging market ETFs provide diversification across countries and growth drivers. Saudi ETFs provide focused exposure to a specific economy with unique characteristics. Understanding these distinctions allows investors to make more informed allocation decisions based on portfolio needs rather than short-term performance. This content is provided for educational purposes only and does not constitute financial advice. For a structured comparison of Saudi ETFs, emerging market exposure, risks, income characteristics, and portfolio positioning, download the full Saudi market guide linked in the description.